Hello, welcome to Magna Forex Institute, the trading channel that focuses on trading psychology rather than some realization about a strategy. If you have any questions concerning Forex, you can send an email to me at magnafxinstitute@gmail.com, or you can send it to my Instagram at magnafxinstitute. Let's get into the video. Risk management. In this video, I'll be explaining what risk management is, why risk management is important, where traders go wrong with risk management, why should you predefine your risk, and how to calculate your risk. Risk management is an important factor in your trading toolbox. Without having proper risk management, you cannot be a profitable trader in the long run. With proper risk management, you'll find that in the long run, you will be a profitable trader by taking small losses and huge wins that will compensate for your losses. With proper risk management, you have the confidence to hold your trades for longer periods of time and will not be susceptible to any thinking mechanisms that may cause you to make errors that are detrimental to your account. Ignoring risk management will not make you a successful trader in the long run. Beginner traders or traders that have not found success in the market are not aware that trading is not a short-term game but a long-term game. Trading is a numbers game. Let's say he puts on a large position on a trade, and whenever he loses that money, he will not be comfortable and his account may be affected. The trader will make psychological errors. This may be cutting the trade early. This may be letting the loss run. These are the errors the traders. These are the errors the trader makes, and errors that lead to him being unsuccessful in the market in the long run. Your profitability is always shown in the long run by keeping your risk low and your reward high. By keeping your risk low and your reward high, you find out that in the long run you are a profitable trader. But new traders simply ignore this fact. New traders come into the market with the thought that they will be rich quick because of what they are being shown online by the people that are already successful in the market, and they think that they can buy a supercar real quick. And when they have this mental belief in their mind, they will come into the market and ignore the measures of risk. The habits that they develop is putting on a trade with a large position size. Some even go further as not putting a stop loss at all, believing that the market will go in their direction. They are not aware of the probabilistic nature of trading. Where do traders go wrong with risk management? Typical traders usually make this error when they come into the market thinking that they are going to make lots of money in a short period of time. They also ignore risk because they believe that they really have to know where the market is going next in order to make money. They have not accepted that every opportunity in the market is unique. They have the belief that they always have to be right on the direction of every trade they take. Again, typical traders or new traders or traders that have not yet found success in the markets or are still struggling in the markets have this belief that every trade they take will result into profit. This may lead them to putting on positions with a high lot size, removing their stop loss, moving their stop loss, and overall affecting their growth as traders. You have to remember that trading is all about the long term, and you always have to predefine your risk so that you are comfortable with the money you are going to lose. They are unaware of the probabilistic nature of trading, that every opportunity in the market is not the same as the last one. The The overconfidence that comes with the streak of wins also causes traders to ignore their risk management plan. This is due to the association of trades. Traders usually associate the trades. When beginner traders go through a streak of wins, they will think that they have mastered the market and now nothing can really happen to them. But they do not know they are one trade closer to a loss. So if they have a streak of maybe 3 trades, all 3 trades are winners, on the 4th trade, they will think of increasing their lot size or putting up more than one position. But they are unaware that that trade might lose. They do not know that anything can happen. And when that trade loses, they lose a significant amount of money, and they will resort to saying that their strategy did not work, and they will resort to learning maybe learning another strategy, or maybe trying to improve their current strategy. And they will ignore that the problem was with their risk management and their psychology of associating trades. Always remember that anything can happen in the market, and trading is all about probability. This error also stems from the lack of belief that anything can happen. They are so confident in their trades that they believe there is no chance their trade could fail. Anything can happen in the market because you don't know the number of traders currently in the market. You don't know the people about to come into the market and what lot size they will use. You don't know the direction in which they will be placing their trades, either a buy or sell position. The people that determine where the price is going are the big players in the market. What you do as a retail trader is identify a pattern of one thing happening over another. That's what trading simply is. As you can see for yourself, you identify a pattern. Alright, this pattern is showing that this trade is going up. You place a buy. That won't be guaranteed that the trade will go up. What will determine whether a trade will be a win or a lose is if a huge number of traders believe that the trade will go up or down. If those traders really believe that the trade will go up, they will move the price upwards, or they will place a trade. They will place a huge trade that will move the price upwards. But if these traders think otherwise and place the trade as a sell, your trade might lose. So these factors are not always known in the market. You don't know the other factors. These factors are always unknown to you. The factors that are always known to you are what risk you're putting on, where you're going to take your profit, the pattern that you have identified. Those are the only things you can control. But moving the price, that's not up to you. This is where the probabilistic nature of trading comes in. You do not know when these traders are thinking in line with what you are thinking. But over a period of time, you find out that there are some times where these traders are thinking like the way you are thinking, and your trade goes into profit. But if they are not thinking the way you are thinking, and the trade goes against you, you will lose less. But if it goes in your direction, you'll win more. And if you actually calculate the numbers in the long run, let's say a series of 10 trades, you find out that you are profitable. Hope you understand what I'm trying to illustrate here. If you believe you are right, you are saying you know what over 1,000 individuals are thinking. You see how illogical that sounds. That is exactly what you are implying when you believe that you are right. Why should you predefine your risk? Predefining your risk is important because you will not have any emotional attachment to your trade. You will not be compelled to constantly check your chart, causing you to have conflicting thoughts that lead you to make errors. when you predefine your risk and calculate your risk, you will be able to place your trade and let that trade run. Unlike when you enter the trade without predefining your risk and putting up a large lot size, where when this trade loses, you will not be comfortable with the amount of money that you have lost. If you put up a trade like of this nature, you have you you will start constantly checking on the market, and you will lose your focus. You will start thinking of the potential loss you might have, rather than looking at the signs showing you that the trade is just retracing. When your trade fails, which of course there is a possibility of that happening, no matter the strategy you are using, you will not be affected, neither emotionally nor financially. Unlike when your risk is high, you will constantly be checking the chart because you are not comfortable with losing the money, and this is bad for your focus. You will not be perceiving the information the market is presenting, because your perception will be clouded with fear, making you susceptible to making errors. With any slight tick against a trade, you will begin to have wrong perceptions about the trade. When you keep your risk low, you will learn to accept the possibilities of every trade without making any errors. That will affect your consistency. Most especially, you will take every trade that aligns with the confluences you look for to execute a trade, making you a consistent winner in the long run. He is saying, if traders only had a specific amount to risk, all their emotional pain and financial loss would cease to exist. You have to know how much money you are willing to risk before you enter your trades. Set the risk according to your account size and where you executed your trade. Risking low allows you to let the trade run, accept the outcome, and move on to the next trade without any emotional frustration or hesitation to execute the trade. This does not mean become reckless. When you identify your pattern, or what you look for in the market to execute a trade, always predefine your risk before you enter that trade. Always predefine your risk before you enter that trade. When you predefine your risk, and if the trade loses, you will move on to the next trade without having any emotional attachment to your previous trade. You will execute your next trade flawlessly, without any clouded mindset, and in the long run, you'll find that you are profitable. You see how important predefining your risk is. Try this exercise for some time and tell me how it works out for you. Risk management bad habits. Stacking. When a trade goes into a loss, some traders will attempt to enter the trade once again. This may double the amount of money you might lose. Remember, not every trade is guaranteed, no matter the signs or signals the market is displaying. Not all trades will be profitable. Most of your trades will go into profit and may come back down and take you out. Most of you may testify to this happening to yourself. This is why having a profit-taking strategy is also important. I will make a video on that later. Amateur traders do this because they think that the trade might come back around, only to realize that this was a big mistake after they have lost a significant amount of money. Professional traders will only have one position open unless they are swing traders and scaling in, often entering when they are in profit. This is advanced trading and done by people who have experience in the market. When your trade comes into drawdown, you may want to execute your trade again, thinking price is at a discount level and if you place a trade now, you may double your chance of success. This is not true. Not every trade is guaranteed. Again, not every trade is guaranteed. This trade may actually be reversing because the market players, the people moving the price, are thinking otherwise to what you are thinking, or are not in line with what you are thinking. This is why putting on a trade with proper risk is very important. If you put on a trade with proper risk and that trade loses, you will find that you have not affected your account that much, and your psychology will still be on point for you to move on to the next trade without having any emotional baggage in your mind. Losing streaks. Losing streaks are normal even to professional traders. It's very easy to form bad habits when you are experiencing a losing streak. It's very easy to form bad habits when you are experiencing a streak of losses. However, remember to stick to your trading plan no matter the experience, wins or losses. To be successful in trading in the long run, you do not have to be influenced by the outcome. This is what beginner traders or typical traders do. They are influenced by the outcome of their previous trades. Again, every moment in the market is unique. I have already explained how every moment in the market is unique. There will always be a different number of traders in every situation in the market. There will always be a different number of traders in the market. There will always be a different amount of money they are placing in the market. There will always be a different direction in where they are placing their trade in that particular market. You do not need to know what is going to happen next in order to make money. Trading is a numbers game. You can still get 20 losing trades in a row out of 100 trades and still be profitable. It is all about probability. Think of it as flipping a coin. You can correctly predict the outcome at just one flip. If he flips it the second time, you might get it wrong. But if you have a series of flips, you will find out that you got a number of them correctly. Now relate that scenario to trading. But your strategy has to be proven that it is a profitable strategy in your demo account. This is why a demo account is very important. Some of you may neglect the demo account. Yes, the demo account is very different from a real account, because in a real account the risk is there. You are really risking real money. But in a demo account, if you prove that your strategy is profitable, it won't be difficult for you to adjust in the real market. When you come into the real market and see that you have profitable results, you can implement the same strategy that you used on the demo account in the real account. You can come into the real account with the confidence, without the fear, and execute the trades flawlessly. After experiencing a losing streak, traders usually get emotional and begin to make fear-based errors like moving the stop loss, revenge trading, hedging, meaning entering a buy and sell position in one market. When they enter a buy position and the trade begins to go against their position, they will enter a sell position, thinking that one trade will compensate for the other. This will only affect their account and their psychology. I'll explain about this later. Closing trades early, etc. What you have to realize is that losses are normal. In this case, you can remain disciplined and stick to your plan, or you can take a break from the market. Taking a break from the market simply reorganizes your mind to be more clear and to come into the market and analyze the the charts from a clear state of mind, which is efficient for being a profitable trader. If you come into the market with an emotional mind, you will simply perceive the emotion to be a threat. You simply perceive the information to be a threat, and you might make trading errors. Stop loss. Your stop loss should always be determined before you enter a trade. Do not touch your stop loss once you have opened a trade. The more you play with it, the worse things will become or will get. For example, an amateur trader who may have gone through a losing streak will attempt to keep their stop loss as small as possible, and their trades will not have room to breathe, causing them to take small but detrimental hits to their account. Other traders will begin to panic when they see price approaching their stop loss, causing them to move or completely remove their stop loss. This trader hopes that there will be a reversal. This is an irrational move, and it leaves the trader with an unlimited potential for loss. Your stop loss is there to protect you from losing too much money in the market. Predefine your stop loss before you enter a trade to protect yourself from blowing your account. The stop loss is really important. I remember when I began trading, I used to move my stop loss a lot, thinking that when the trade starts to come against me, it will take me out and I'll be safe from losses. But I found out that by moving my stop loss, I I took myself out of the market more often, and and price would actually start reversing back into my position and coming into profit and going into my direction and leaving me with small losses, but those losses were really affecting my account and really affecting my growth. Then if I see that the trade is going into my direction, I would enter the trade again, and usually when I enter the trade again, it would be uh, it would be close to my target. It would be close to my target, and I would gain less pips. Hedging trades. Hedging occurs when a trader places a trade and it is going against them. Then they will re-enter then they will re-enter that trade, but this time place a trade in the opposite direction. The trader assumes the trade opened will cover for the loss of the other trade, but this is far from the truth. The trader the truth is the trader will begin to panic when the trade is going against him or her, and out of frustration, sorry for the spelling of frustration, typing error, and out of frustration, the trader will open a position in the opposite direction. The trader is only giving more commission to the broker, and it also puts stress on his psychology and account. To make it worse, when the trade begins to consolidate, the trader might even begin a frenzy of opening and closing trades. Always trade according to your plan and maintain the discipline to see the outcome of the trade. In the long run, the numbers will tell you if you are profitable or not. I also had this bad habit. All the bad habits I've listed here are all the bad habits I developed. These bad habits are usually formed when traders come into the market thinking that that the market will make them rich quick. They usually don't think of the psychological part of trading, but the strategy part of trading. But in order for you to be successful in trading, you have to bring those components together and lift yourself up to become a successful trader. So usually when I place a buy trade and I see the trade beginning to start reversing, I would, out of frustration that the market is out to get me. So me thinking that that thinking of trying to be let me say trying to be trying to take control into your own hands, or out of frustration, you you place a sell trade with the thought that I'll show the market, I'll show it that I can get money from it. And actually, I was only exposing myself to more risk and actually causing damage to my account and my psychology. So when you when you plan your trade, always trade your plan. This is another component of trading. Plan your trade and trade your plan. Never trade against your plan. You will find out that when you trade against your plan, you will not be familiar with what the market is doing. But if you create a real story of what you are thinking the market, if you create a story for yourself of what you are thinking the market will be doing, and you're actually following the price, you'll find out that you can actually stay calm in the presence of uncertainty. You actually maintain your mental balance when the trade is doing what you are not expecting it to do, because you know what you are expecting from the market. So one thing I learned from Mark Douglas is a trading psychologist. I recommend you to watch some of his videos on YouTube. Mark Douglas says, "Be rigid in your trading plan and flexible in your expectation." Always be flexible in what you expect from the market, but be rigid in your trading plan, because the market will not always react to what you are expecting. But if you keep your plan solid and your plan is a profitable plan, you will find out that in the long run you are a profitable trader. You have noticed that I have talked about long run a couple of times. Yes, long run. Think of trading in the long run. Do not think of it in the short term. It's not uh, it's not about short-term gratification. It's about long-term gratification. The numbers will always speak for themselves in trading. By taking small losses and taking large wins, you see that the numbers are growing. Trading is all about keeping the curve upwards, the profitable curve upwards, allowing the trade to breathe. Remember that sometimes when you enter a trade, it will not immediately go into profit. You might experience some drawdown before it can continue to go into profit. A common trait that amateur traders have is that they panic when they see price going against them, even by just a few pips. Remember that not every trade you execute will go into profit the moment you execute the trade. In fact, 70% of the trades you execute will not immediately go into profit. Why should you begin to panic when you have calculated your risk and set your stop loss? That sounds illogical. When you have calculated your risk and set your stop loss, why should you start constantly thinking of how the trade will lose? As I previously stated, you do not have to know where the market is going for you to make money. The numbers will speak for themselves. If you have set your stop loss and you have accepted the risk, just let the trade run. Make sure that your strategy is profitable, but you will not know which trades will be winners or losers. But from a string of trades, you will know that you are profitable or you are not profitable. Just like flipping the coin. When you flip the coin, you will not know if you will get either the heads or tail right. But with a string of guessing, you'll find out that you got a number of them correct. So, you see how wrong risk management rules can affect your psychology and overall affect your trading success. what you can simply train your mind to do is accept the risk. Accept the risk in trading. That's what trading is about. Set your risk and accept your risk. If your risk is low and you are comfortable with losing that money, you allow your trade to breathe and you allow your trade to run no matter what happens. But if you are not comfortable, if you have placed a trade with money that you are not comfortable with losing, you will lose your focus and your mind will let you perceive market information in the wrong way. So learn to accept the risk. How to calculate your risk? Before you enter a trade, you first have to determine how much you are willing to risk on a particular trade and how much you will earn on that trade. Most traders risk high to earn less. The amount of money you are willing to risk should be determined by your account size. I suggest the calculation should be 1 to 3% of your account size. So, for example, if you have an account of $1,000, $30 would be your 3% risk or drawdown. A good risk reward ratio would be 1 to 3, risking 3% to gain 9%. With a $1,000 account, you would be risking $30 to gain $90. So say you have a valid setup which requires a 30 pip stop loss. To find out what lot size would be best for the trade, you would divide the amount you are willing to risk by the number of pips your stop loss is away from your entry. That is $30 or 3% risk divided by 30 pips your stop loss, which is equivalent to $1 per pip, or your lot size will be 0.10. The best risk reward ratios. Your minimum risk to reward ratio should be not less than 1 to 1. Risk reward is simply the ratio between the money you are risking to the money you are earning on a single trade. Never enter a trade where the risk outweighs the reward. You can use the position size measuring tool on TradingView to determine the risk to reward ratio. As a matter of fact, I suggest the platform that you should be using to analyze your charts should be TradingView. I know most of you use MetaTrader. Choose what's suitable for you, but I prefer TradingView to MetaTrader because TradingView shows me the TradingView platform has more tools than MetaTrader, and the platform is just more neat. I prefer TradingView to MetaTrader. To determine the risk reward ratio, a higher risk reward ratio is good because it eliminates the need to constantly find further setups. The more time you are in the market, the more you are exposing your capital. It's good to find risk reward setups that have a higher risk, let's say a 1 to 5 risk to reward ratio. But these type of setups usually takes time and patience from you. But if you find these type of setups and you execute these setups, you will find out that you have gained a significant amount of money, and you probably won't need to trade the whole week. This will actually protect your money. Examples of risk to reward ratio. If the risk is $100 and the reward is $200, then the risk reward ratio is 100 to 200 or 1 to 2. This risk to reward ratio is a normal risk to reward ratio if you want to recover from your losses and gain profit in the long run. Number two, if the risk is $100 and the reward is $500, then the risk to reward ratio is 100 to 500 or 1 to 5. This is an example of a high risk to reward ratio. You are risking less to earn more. You are risking less to earn more than your weekly targets. It is important to make weekly targets when you're coming into the market. Make sure you make realistic targets so that you are not under pressure to make money. And when you reach your target, you can easily come out of the market and expose your capital less. Number three, if the risk is $200 and the reward is $100, then the risk reward ratio is 200 to 100 or 2 to 1. This is an example of a risk to reward where the risk is higher than the reward. When you use this risk to reward ratio, recovering from your loss in the long run will be more difficult because you will lose more than you will win. So making your money back in the long run will be a little bit difficult. Thank you for making it this far. As a sign of gratitude, I would like to leave you with a few statements from Sean Lee that can help you on risk management. Risk management is just as important as finding the trade. One poor risk management trade could lose your account. One poor risk management trade could lose your account. Let the trade breathe. Does the trade make sense? If you have any questions, you can send them through my email, Instagram, or leave them in the comments below. If you have learned anything from this video, don't forget to share, like, and subscribe. See you in the next video. Thank you.